Peter, great to see you as always. I guess the headline from your last few notes that I've been reading is increasingly cautious.
Yes, happy holidays, Wolf and Sarah. Yes, I think that's right. You know, Mike made some wonderful points. One of the things that speaking to the S&P's stellar performance this year does not address is the dispersion in equities more generally. When we look at small caps, for example, the Russell 2000 made a high in March. It made a brief breakout high again in October or early November, but it really has been range-bound to lower most of the year. The S&P is not at all representative of all stocks. We can also see that relative to breadth for the New York Stock Exchange Composite, where there are let's call it under 50% of the stocks there are under their 200 or over their 200-day moving average. And even within the S&P, we see stock performance struggling to get above the 50-day moving average. So it's really been, the stocks that we all know so well, a handful, maybe a half dozen stocks that have really been driving S&P performance. And when I look at the bigger picture items going into 2022, we have a Fed that has really novel constraints on its hands. It's got persistent inflation. And it's already at the zero bound with funds. And why that's important is if we hearken back to 2018, we remember when things started to slow and the economy started to wobble a little bit, Fed was able to cut from 250 to 175. And that it cured the yield curve inversion, and it did just enough to stimulate the economy and to get asset prices to rally after a 20% drawdown late 18. It doesn't have that tool at its disposal right now. Rates are really hugging the zero bound. The only thing it can really do is use its tools to fight inflation. And that in and of itself, obviously, could cool the economy.
And is year-end itself, Peter, a potential trigger for selling or not so specific as that?
Well, I wish I had a great answer to that question. Year-end is very tricky. It's very hard to assess what flows are going to look like into year-end, especially when there are lots of buybacks. And when institutional investors are dressing windows, meaning that they buy more of the names that work well into the end of the year. And I think we really did see that in the spectacular 5-day run that we saw until just today. So I think year-end is very hard to use to extrapolate anything into next year whatsoever.
Peter, I feel like you've been bearish pretty much all year. Am I wrong? I mean, since we talked to you in the beginning of the year, you were worried about higher taxes and higher bond yields hurting the market. What do you think surprised you most about the fact that we're ending this year now? It looks like up 27.5% on the S&P 500.
Yeah, I would say that's a touch of a mischaracterization, Sarah. I don't think I was bearish all year. I think I got a little bit cautious in May and then, overtly bearish in July, pretty much across the board. My focus all year has been on small caps and their underperformance due to what I believe is going to be continued margin pressure as we go into 2022. And I think what surprised me a little bit, though, was the ability of companies to weather the inflation storm. Upon further analysis, however, it really does make sense that companies were able to do so for the first half of the year. And when we look at instances when PPI exceeds CPI, as it is now, it really happens with a bit more of a lag than I think I anticipated, usually 1 to 2 quarters. And I think that's going to catch up with company earnings coming into 2022. So if there was a surprise for me, it was the ability of companies to weather the inflationary pressures. Frankly, though, that we saw coming, but that the market weathered better than we felt it might.